Hello, hello. I am coming to you on Monday, March 17th, 2025. In light of recent stock market volatility that we've been experiencing, my broker-dealer, LPL Financial, and their research department put together this presentation that I thought was very well done and would like to share with you. This is the history of the stock market, specifically the Dow Jones Industrial Average, from 1900 to the end of February 2025. You can see that stocks have compounded at a very attractive 10.1% annual growth rate. Although the Dow cannot be invested in directly, this is an attractive potential return over time and highlights the attractive potential of long-term investing. The Dow Jones finished at 43,841 points February 28th of 2025. As of Friday, March 14th, 2025, the Dow Jones Industrial Average closed at 41,488 points. Year to date, the Dow Jones is down 2.1%. Stocks have historically risen much more often than they have fallen. Based on rolling monthly time periods since 1950, the S&P 500 has risen on a price basis excluding dividends 92% of the time over 10 years and 100% of the time over 15 years. Over shorter time periods, gains are less likely, but are still much more likely than not. The key takeaway is to stay invested. Focus on the long term, not the quarters or the months where the market displays volatility. Timing the market can be costly. Missing the market's best days can be very punitive relative to remaining fully invested over time. If a person had stayed invested in the stock market, specifically the S&P 500, from 1990 to the end of December 31st, 2024, the return has been 9.8% in that index. Missing the best day during that time, returns dropped to 6.1%. Missing the 10 best days in the market, the return drops to negative 12.5%. This is why advisors encourage investors to stay the course. This chart shows the historical performance of each presidential administration going back to 1933, which was Roosevelt's administration. The key takeaway: do not let your political leanings influence your investing behavior. Down years are rare. They happen and they typically come around recessions. Over the past 65 years, the S&P 500 index has only been down big 5 years. Being down big is defined as negative 15% or more. All came during or around recessions except 2022, which certainly had some characteristics consistent with recessions, and the unprecedented spike in yields, also in English said as interest rates, from historically extremely low levels. This chart shows the history of stock market corrections or pullbacks. They can also be called a downturn. To have a 5 to 10% downturn in a year is extremely common, and we typically have 3 of them per year. Even a correction of 10 to 20% is again very normal. Typically happens 1 time per year. This chart further explains volatility. Volatility, like I said, is normal and happens quite often. This is one of my favorite charts. Shows the calendar year performance going back to 1980. Calendar year performance is displayed through the navy blue vertical line, but each year has an orange diamond that shows the low point that we experienced during that year. Historically, over the last 45 years, the market has been positive 34 times. Again, volatility is normal. On average, stocks are up about 9% a year. However, the average pullback is nearly 14%. Also consider that on the average max drawdown in a positive year for the S&P 500, the average max drawdown is 10 to 11%. Last year, in 2024, the S&P 500 index maximum drawdown was 8.5%. This year, it's close to that as of March 11th, 2025, at 8.6%, which is still below the long-term average. In other words, volatility has been relatively low the past couple of years and is likely to increase amid heightened trade policy uncertainty, less fiscal stimulus, and a maturing business cycle. This chart further reiterates the volatility experienced during a short time period. The green line shows the performance of stocks. The blue line shows the performance of bonds. The gray line shows a balanced portfolio allocated 60% stocks, 40% bonds. In a 1-year period, if you're invested in stocks, one can experience swings of positive 52% to negative 37%. Go out 5 years and that volatility condenses to positive 29% to negative 2%. The further you get out, the more that line and that volatility condenses. Earnings have continued to grow nicely over the long term and an average 7.9% since World War II. That being said, I want to talk about something I've noticed in the last 3-ish years, and that's the performance of the stocks called the Magnificent Seven. The Mag 7 stocks are Tesla, Nvidia, Amazon, Apple, Microsoft, Facebook, and Alphabet, which is known as Google. These companies collectively make up 35% of the S&P 500. So if one or two of them have a really bad day or a really good day, the whole index can look like it's doing bad or doing well. When that may not be accurate, it might just be how those few companies are doing. This chart isolates the performance in the green line of specifically the Mag 7 stocks. The gray line shows the S&P 500 with the Mag 7 stocks included. You take out those Mag 7 stocks, and that's the S&P 500 indicated in the blue line. So again, it's important to know what the index is doing, but also keep it in perspective with how heavily weighted the index is towards those 7 stocks. Stocks tend to rebound sharply off correction lows. From the lows after a correction, the S&P 500 generates solid gains with a very high probability of advance. Bear markets have historically recovered fairly quickly when not accompanied by a recession. On average, bear markets without recessions recover losses in 10 months. Recessionary bear markets take an average of 27 months to recover losses. LPL Research does not expect a recession in 2025 or a bear market. However, if the S&P 500 enters a bear market and the team is right with its economic growth forecast, the recovery is likely to be quick and sharp. Stocks have historically been resilient to geopolitical shocks. Historically, stocks have fallen an average of about 6% following these serious events listed on this slide. It has historically taken just 22 calendar days on average for the S&P 500 to bottom following these events, and an average of 48 days to recover those losses. So, this too shall pass. Volatility, as we've experienced before, shocks to the system we've experienced before. Stay calm, stay invested. Call me if you have any questions. I'm happy to talk through it.